Hey guys, and welcome to another episode of Forex XO. Market makers try to deceive traders to enter the market in the wrong direction to increase their profit by grabbing the liquidity they need before making their moves. Imagine we are in an uptrend and market makers want to push the market from point A to point B. So here they want to buy a large number of shares, but the problem is nobody wants to sell because everyone can see that we are in an uptrend. So they deceive traders and make them sellers buy. It is a simple trick. And then they buy it all and continue their move to the upside. So in this episode, we will explain the key concepts of market makers trick along with our Forex XL strategy to not only fall for this trap but make profits out of it. So if that's something you are interested in, please subscribe to our YouTube channel and hit the notifications bell to know exactly when we release new content. Also, you may comment below with your thoughts and questions, and we will do our best to answer them all. So before we explain the market maker's trading setup, there are two critical principles about trends and fake outs that you need to understand deeply. So let's start with the trends. It is needless to say, in an option market makes higher highs and higher lows, but the problem is market barely moves. This clear and is often choppy or ranging, meaning there's no momentum at all. So in this example, here comes the question. Are we still in an uptrend? What about now? So the answer is yes. We are in an uptrend until we get a candlestick to break and close below this higher low. So here is another question. Which of these lows is the higher low we are looking for? So the answer is we identify the lowest point of correction move as a higher low only after breaking the structure to the upside. So in this case, here is our higher low, and breaking it to the downside can signal a possible trend change or a change of character. Remember, the same thing applies to the downtrend. So let's apply this concept to a real chart. In our example, we have a downtrend with a high, low. According to what we said earlier, we are in a downtrend. As long as we stay above this high, in the next moves, price broke the structure level to the downside and made a new lower low. So this is our new lower high. And once again, as long as we stay below this level, we are in a downtrend. And then market continues to make lower lows and lower highs until we get a break and close above previous lower high. After that, we are no longer in a downtrend. So if we see a market shift, that's the time that there's a possible uptrend. Now that you know the trend and market structure basics, let's talk about fake outs. A fake out is a failure breakout that occurs when the price breaks outside of a chart pattern but then moves right back inside it. Imagine we are in an uptrend and the market breaks resistance to the upside. Or should we say the market breaks within the demand zone going to the upside. So when the market pullbacks to this zone, we expect this level to act as a demand zone now and reject the market to the upside. But if it breaks right through any or without any hesitations, we call this a fake out. Or sometimes we call it liquidity grab. So here is an important point. Fake outs indicate the momentum on the opposite side of the direction and it can signal a possible direction change. Here we had an uptrend until we got a fake out, and the market reversed from here. Now that you know all the concepts required for the market maker's trading setup, let's jump into it. So once again, imagine that we are in an uptrend and the market makers want to push the market from point A to point B. And let's suppose that they want to buy 1,000,000 shares before reaching the B, or reaching this price in point B. But the problem is, everyone knows we are in an uptrend and the price is more likely to rise. Everybody is looking to buy and no one wants to sell. So if the market makers enter the market now, the price will reach point B immediately without giving them a chance to buy the amount they want. So this is how they make people sell their shares, with a simple trick. They will create a consolidation area or a ranging area, building a liquidity and break it into the downside or upside. So many people think that the uptrend is over and the market will reverse. So they enter short positions like this, and the market makers jump into the market, grab all the liquidity they need, and push the market to the upside. So this is how we approach this market. When price gets back the consolidation area, it gives us buying opportunity. We will enter a buy position with our stop loss protected below this level, and we will target the next level of structure. So let us summarize what we said in 2 steps. First, we have identified that this is a moving uptrend until we get a break and close below the higher low. So we have a bullish overall bias. Second, we have noticed this fake out that could be a possible signal for a trend change. So for the short-term downtrend, and then we will execute a long trend when we get a break and close back into this consolidation area. So here comes an important point. This strategy is a trend continuation strategy, so avoid using it in every market scenario. Meaning, only use it when we have an obvious trend. So, traders, I hope this video had some value for you. If it has, please give this video a thumbs up and subscribe to our channel. For more trading strategies and tips, also feel free to comment if you have any questions, and we will work our best to answer all of them. See you in the next episode.